Medical Properties Trust, one of the most spoken about dividend stocks, just got their dividends to 15 cents a share, coming all the way from 29 cents a share. This makes their current yield stand at around 9%, which is still high even after an almost 50% haircut. In this video today, we're going to look at the changes with the recent update and try to forecast on what comes next. So, with this dividend cut, their dividend is much safer with a near-term AFFO payout ratio of less than 60%. Prior to this, it was sitting at above 90%, meaning that they would not be able to cover their dividend payouts if their AFFO fell ever so slightly. As per the CEO, the focus of MPW currently lies on reducing leverage and improving the long-term cost of debt and equity capital. In today's video, we're going to analyze the company in 3 steps, and in this first step, we're going to be determining the margin of safety used in the valuation that we'll be performing in the final part of this video. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company, and we'll be using a standard margin of safety of 25% that can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from margin of safety. We'll be using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. In conclusion, we will combine all steps and determine the fair market value of Medical Properties Trust as of today, including the recent dividend cut. The first metric that we use is the EBIT growth. For MPW, this is looking very solid, with the 2013 EBIT being $97 million, going all the way to $705 million in 2022, which is an average EBIT growth of almost 30%. This awards them with a 10% deduction from the margin of safety. As for the margin growth, it has also increased very nicely over the years. The margin has grown from 39.4% in 2013 to over 44.5% in 2022. This gives them yet another 5% deduction in the margin of safety. Next up, we have the dividend growth. Of course, with the dividend cut, this is the metric that has changed the most since the last stock analysis we made. It has now gone down from 80 cents a share annually in 2014 to 60 cents a share now in 2023, with today's cut making it the lowest quarterly dividend payout ever in the company's history. With this, the average dividend decrease is sitting at 1.7%, adding 5% to our margin of safety. The next metric we are looking at is the debt to EBITDA. MPW is very heavy on debt, with their debt position being 2.5 times larger than the company's market cap. To determine this ratio, you have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt, and for MPW, this is over 7.5 years with a 755% debt to EBITDA ratio. This is way past our scale, indicating a 5% increase in the margin of safety on this metric. And the next metric we'll be looking at is the occupancy rate. Occupancy rate is a key metric used in real estate analysis to measure the percentage of occupied rental units or properties within a specific portfolio. The occupancy rate for MPW is 99%, which is a very solid number. This means that only 1% of their property is currently vacant and not generating any rent, awarding them with another 5% deduction in the margin of safety. And the last metric that we'll be using is the rent reversion rate. Rent reversion refers to the potential for rent rates to change when leases are renewed or new tenants are acquired for a property. The rent reversion for MPW is not looking very great, as we can see their rental revenue is going down compared to their gross property. This indicates that they are generating less rental revenue from their properties. There was a massive increase in gross property in 2018, while they didn't increase their rental revenue by that much, causing the rent reversion rate to stand at a negative 5% over the past 5 years. This adds 5% to our margin of safety. Now that we have gone through the company's financials, we're going to be performing valuation to see how attractively priced the company currently is. The first model that we'll be using is the price to FFO mean reversion. The price to FFO, or funds from operations mean reversion, is a valuation model used to assess the attractiveness of a REIT stock price based on its historical FFO multiples. FFO is a key metric for REITs as it represents cash flow generating from their core operations. In this model, we compare the current price to FFO to its historical average. If the current ratio deviates significantly from the historical mean, it suggests that the stock may be undervalued or overvalued and is expected to revert to its mean over time. We've imported the share price together with the FFO per share of the past 9 years. With this, we can calculate the average price to FFO of this time period, which is sitting at 13.86. If we do the same with the trailing 12 months data, we get a trailing 12-month price to FFO of 4.46, which is significantly lower, giving us a fair value out of this model of $21.62, which is a crazy 210% upside. second valuation model that we'll be using is the discounted dividend model. The dividend discount model is a valuation method that calculates the present value of expected future dividends to determine the fair value of a stock. It assumes that the intrinsic value of the REIT is the sum of all its expected future dividend payments discounted back to the present using a discount rate that reflects the risk associated with the investment. The model is based on the premise that investors value the income generated by REITs' dividends and that the future dividends are a crucial factor in determining the stock's worth. In this model, we've imported the dividend payouts of the past 4 years and the expected dividend payout with the new determined upcoming payout. With this, the average growth is negative 8.78%, and I'm projecting no future dividend growth for MPW since a lot is currently unclear. And we'll also be using a 10% discount rate, giving us a fair value of $6 out of this model, which is just under a 14% downside of this model. The next model that we'll be looking at are the AFFO multiples. Adjusted funds from operations, or AFFO, is a measure that reflects the REIT's FFO adjusted for capital expenditures and other non-recurring items necessary to maintain the company's portfolio. AFFO is considered a more accurate representation of cash available for distribution to shareholders. The AFFO multiple valuation is similar to the price to FFO, but it uses the AFFO metric instead. By comparing the current market price to the AFFO, we can assess the relative value of the REIT compared to its peers. In this case, we've imported the price to AFFO ratio of similar companies to MPW. On average, this ratio is sitting at 11.47. This is quite a bit higher than MPW with a price to AFFO of 5.61. This gives us a fair value of this model of $14.23, which is an upside of over 100%. And the last model of today's video is the net asset value model. Net asset value is a straightforward valuation model that estimates the value of a REIT based on the fair market value of its underlying assets minus its liabilities. The value of a REIT's assets is typically determined by the appraisals of its real estate properties. Net asset value can provide a good indicator of a REIT's intrinsic value. We've imported the net operating income of MPW and applied a growth rate estimate for 2023, which is, in this case, we have sitting at minus 5%. This gives us the net operating income for 2023. Then we apply a cap rate, which we have sitting at 4%, giving us a value of their underlying assets at $15.3 billion. After that, we subtract their $10.4 billion debt position, leaving us with a net asset value of almost $4.9 billion. Dividing this by the number of shares outstanding, we're left with a fair value of $8.16, which is an upside of over 17%. Let's go look at the final overview of a valuation next. Coming to the final overview of a valuation, we've imported the price to FFO, AFFO multiples, discounted dividend, and the net asset value price per share, giving us an average of $12.50 a share. And with the current price of $6.96 a share, we get an upside of almost 50%. Keep in mind though that with the current change you will be paid out much less dividends, and the only way for the company to appreciate in price is for them to use this reduction in leverage to improve their financials and resolve tenant related issues. This would make them able to start increasing their dividends in the future again. There are also still risks of tenants defaulting on their rent payments, making MPW still a mildly risky asset to own. By the way, if you want to get access to the valuation models used in these videos and much other spreadsheets, you can check in the description for my Patreon link. And looking at the fair value that we have determined of the company, it comes very close to the recent high that we have had in July, right before earnings hit and the stock collapsed. The company will need to regain a lot of confidence from investors to make it hit this price target, and many other things are still unclear. Compared to the history of the company though, it's dirt cheap. And that wraps it up for this video. I really hope you enjoyed this different approach to a stock analysis than we usually do on this channel. If you don't want to miss any of the other dividend related videos that we make, be sure to hit the subscribe button, and thank you so much for watching. See you in the next one.